Good afternoon, traders, and welcome to Phoenix Blues Daily Update. My name is Nishal Patel, and I'm going to be giving you a rundown of the markets so far today, and most importantly, this week. It's a big day. Not only is it Friday, and yes, we do have the weekend looming, but we have the key economic symposium at Jackson Hole, Wyoming, USA, later on this afternoon. So all eyes and ears most certainly going to be tuned in for that. But what we're going to do is we're going to have a quick brief look at the market right now and see how the market's panning out across most of our FX instruments. Taking a look at the dollar index right now, floating at not just above 93. Stayed relatively flat this week, obviously with very thin liquidity on the marketplace. Yes, it is August, but we've also got some key speakers, being Janet Yellen, the head of the Federal Reserve, and obviously Mario Draghi, the president of the European Central Bank, speaking later on, in which we're going to discuss in a bit more depth a bit later. So as we can see on the dollar index, not really too much change there. And moving on to the next chart of focus is the euro. Now we're having a look at euro right now on this daily time frame, currently floating at 1.1818 to the US dollar, staying fairly flat and in this area of consolidation, which it has been over the course of the last fortnight, but definitely in the upper end of this area of consolidation that we're seeing right now on this chart. Definitely the dollar index is heavily weighted to the euro, so the euro being the primary driving factor for that dollar index, and most certainly for the markets and the foreign exchange markets for this week. That being said, obviously we have had very thin liquidity, I should say a lack of liquidity, and any kind of movement that we've seen has primarily been has primarily been euro driven, and which most of you probably have seen if you were trading on an intraday environment. Moving on forward right now, just having a look at the yen propping up off this area of level of support and resistance. There's a 382 fib that has been drawn off a weekly time frame, and we can see right now it's floating at 109.65 yen to the US dollar. So losing some ground. The yen's losing some ground and literally bouncing off that 109 area. Has been fluctuating. Haven't really seen a break of 108.50 yet, and I think that's key, and that's what most traders have been looking for. Most certainly what we've been looking for, but we haven't seen that yet, which is quite interesting. Moving on to the Australian dollar, again fairly flat over the last 3 days. Right now at 0.7910, so still above that 0.7900 area on the Australian dollar. Not really too much movement. Cable, on the other hand, has started to pick up a little today after rebuffing down. Coming down and breaking down to 1.276570 circa, right now sitting just above 1.2800, exactly at 1.2834 circa, coming up to that 618 fib that I've got highlighted on this chart on this daily time frame, as we can see, from this swing low to obviously this swing high, really coming up and testing that key area of 2850, or coming up to it, and should be testing it, which again would be of some importance, especially as we've seen that tight consolidation over the course of last week, just above that 2850 to the 2900 area, which is highlighted by that red level of support and resistance across my screen. So quite interesting. Obviously, having taken a bit of a knock this week with the strength in the euro, and most of you would have seen that if you switched over to the euro GBP cross chart. Most certainly you would have seen that. The next chart we're going to have a look at is WTI. So looking at WTI right now on this daily time frame, currently floating at $47.67 dollars to the barrel on WTI. And after having this quite a large bearish day, coming back down to the 46.80 area. In fact, this bar is showing at 46.93 on yesterday's low, but closing up just below 47.50 and still staying within the proximity or that area, as I said, just floating just above 47.67. Now, a lot of you probably thinking, well, this looks it looks like it's not moving much today, and that is true. It is not moving. The markets are actually stalling. They're actually waiting out. For those people that have got their news channels on and understand what's happening, they probably would have seen a very strong hurricane right now. It's a Cat 2 hurricane by the name of Hurricane Harvey coming in through the Gulf of Mexico with a path of destruction heading into Corpus Christi and potentially into Houston, which has a huge amount of that area has a huge amount of refineries and obviously, if this hurricane is to actually potentially increase in power, which we've seen it do over the last course of the last 2 days, potentially turning into a Cat 3 hurricane, we could see a serious amount of devastation in that area, and especially with, as I said, with so many refineries, not only in Corpus Christi but also Houston. Many of these refineries may be down for days, if not weeks. Now, they're saying the infrastructure for all these refineries themselves, both onshore and offshore, because there's obviously drilling offshore plants in the Gulf of Mexico, may be down and out for some time, but definitely the infrastructure there shouldn't be massively affected. They have been through various hurricanes before, and they are prepared for such storms. But it's the infrastructure, like roads and general infrastructure to for logistics and what have you, that will be affected, that we may see damage from, and this may cause a problem to and from refineries, even if they are up and working again. So realistically, right now the markets are bracing themselves and they're waiting for more information to see what kind of effects this has. Obviously, right now supplies of oil, of crude, are quite high. We've seen OPEC having meetings earlier on at the start of the year. We know that there was apparently, and I say apparently because not much of it has been followed through. There have been promises of production cuts all the way from Russia and virtually all of the OPEC member states, but we haven't really seen much of that full continue. And most certainly in the US, they're producing at a heavy amount as well. So the price of crude still below the $50 per barrel. But if we do see any kind of restriction in terms of the amount of crude that is produced over the course of the next 2 weeks, then most certainly what we will see is we will see that rise, potentially looking to wait to Monday to see this fly above that $50 per barrel mark, depending on how devastating this hurricane really is and what kind of impact it has. So eyes glued to the WTI chart as well, guys. So moving on forward, I think what we're going to do now is just have a discussion on Jackson Hole. Now, the Janet Yellen is speaking at 5 o'clock BST, and then Mario Draghi is going to be speaking at 8 o'clock, so 8 p.m. Our time here in London, so that's BST as well. And Jackson Hole commonly has been, I guess commonly Jackson Hole has been the place for some key announcements over the years. We saw back in 2014 Mario Draghi use the platform to effectively signal the readiness to carry out quantitative easing in the Eurozone to stimulate inflation. Now, we know that hasn't worked too well in terms of stimulating inflation. We know that we've seen definite growth, but haven't seen too much inflation. But what we did see is we saw the euro plunge during that process. Ben Bernanke, in fact, the previous president of the Fed, Janet Yellen's predecessor, decided to use the event back in 2012 when he made a really strong case for open-ended asset purchases that we or most traders would know as QE3. So definitely a platform in which some key members of central banks use to give the world information on their potential decisions. So what are we going to be expecting from Jackson Hole? Now, from what we've gathered so far, not too much. In all honesty, everyone stayed fairly tight-lipped, and I guess it is really to do with the situation many of them are in particularly Mario Draghi. Quantitative easing, or their asset buying program, which is in the millions per month, obviously is a very unorthodox stance from any central bank, and we've never seen that in history. So closing that down is really uncharted as well. So the effects of this, and particularly on the markets, there is a great deal of uncertainty around it, and many people are cautious and are worried on or I should say, what effects it will take on the market. So definitely something we need to think about, and obviously Draghi's it confirms that 2 years of quantitative easing needs to be dialed back as planned towards the end of this year, and most certainly what we're gonna hear about is tapering. Draghi did mention in his last speech that the governing council is most likely to discuss tapering this autumn. So this potentially could be next month, or in a few weeks. In fact, in September, when the ECB meets up. But the markets will be keen to know any other particular details and exactly when these discussions may exactly start, and if there is an immediate action, or if it's going to take longer than that. However, we do have a huge amount of strength on the euro, as we can see on our charts right now. And if we just flick over to a weekly time frame right now and just have a look at how over the course of this year we've seen the appreciation of the euro. In fact, it's gained a little over or just close to 12% of its value since we saw it bottom out towards early December, and then contained a very strong and bullish momentum all the way through this year, and I think that's going to be a huge problem for Draghi. He's not keen on the strength on the euro, and but at the same time, I don't think he wants to stir too much up in FX markets more than he already has. Minutes from the last ECB meeting actually revealed policymakers are concerned about the euro's rapid appreciation. This is noteworthy not just because it could signal effectively a willingness to wait a bit longer before tapering QE, but also because I think the exchange factors may be a problem themselves. So in regards to this exchange rate, I think there's a potential for some remarks to be given by Draghi that could affect market calm. I think he's going to be very dovish in his manner, but from what we've seen previously, the meetings from the ECB have actually fueled some extremely volatile sessions. Now we may see in the course of the market open next week, especially looking at Draghi's speech and then looking at how Yellen has responded as well, because we've got two heads of central banks right now that are dealing with two very different problems, but at the same time they're very similar. We've got Draghi on one hand that is having to deal with growth in the eurozone, but very low inflation, and definitely it doesn't look as if that inflation is gonna change anytime soon. And we've got Yellen on the other hand that is dealing with inflation dropping quite quickly, which I don't think they were prepared for either. But I'm guessing that Draghi will probably use this opportunity at Jackson Hole to crank down the euro a little lower. By using the sentiment expressed by the ECB in its previous minutes. And I think the concern about the exchange rate could be used as a counterweight to any other remarks around tapering that the market could take as hawkish to a certain extent. But we will see. Now, in terms of the Fed and Yellen's speech, there are two key areas, realistically, from the Fed that we need to be looking for. First is on the balance sheet reduction, effectively uncharted territory, and we could probably expect Miss Yellen to offer further guidance here ahead of the September meeting of the FOMC, where I think the markets are currently expecting the first move to be made. Any kind of hint about the timing and the pace of the reduction, I think, will be closely monitored here. And most importantly, I think having a look at the Fed's July meeting minutes provides us a good background, because these minutes effectively reveal to us that the FOMC thinks it may be appropriate to signal an implementation of the program, and that it would probably begin relatively soon, whilst a few members were prepared to announce a starting date for the program last month. Most of them preferred to defer the decision until an upcoming meeting, while additional information came about from data and economic outlook that may actually affect the markets. The second path is on the federal funds rate, and I think it's really key that Yellen would be looking to address this, in particularly about the stability here. But again, looking back at the minutes from FOMC's last meeting, there were growing concerns about inflation, which could deter the Fed from hiking again at any point in this year. In fact, quoting, there were a few FOMC members expressing concern about the recent decline in inflation and believe that the Fed could afford to be patient under current circumstances. Now, the hawks on the FOMC effectively are worried about the risks of the labour market, and they probably project this to tighten to a certain degree, and potentially backing off from hikes. Now, I think the Fed kind of risks overshooting an employment problem poses risking financial instability. I think we can characterize this really well as a trade-off between inflation and financial instability, and I think Yellen here is going to have to be a little cautious, and she may have to signal, or actually signal a readiness to overlook a slightly softer inflation figures, which the markets may take as relatively hawkish. So quite it's gonna be very interesting, and all the eyes and ears are most certainly going to be looking forward to the symposium later on this afternoon. Well, guys, I've just given you a backdrop of what we could potentially see, and most certainly this is my interpretation of how I view what will happen later on this afternoon. But we won't know until they open their mouths a little later. But that will most certainly give us some food for thought this weekend in terms of the opening of the market for next week. As always, if you've got any questions or would like a greater insight into how we trade at Phoenix Blue and like to adopt some of that, feel free to send us an email at info@phoenixblue.co.uk. Alternatively, visit our website. Until next time, traders, happy trading. Bye bye.